Hello and welcome to the Investec post-OPEC oil briefing. Well, ahead of the OPEC meeting on the 30th of November, there seemed to be three possible outcomes. The first, which seemed quite likely, was that OPEC were unable to agree anything. The second, which seemed possible, was that they might agree a cut to 33 million barrels per day. And the third, which seemed pretty unlikely, was that they would manage to cut to 32.5 million barrels per day. So that 32.5 to 33 million barrels per day range was what OPEC had agreed at its informal meeting in September. But of course we now know that OPEC did manage to reach an agreement to cut by 1.2 million barrels per day, which it said would bring OPEC production down to 32.5 million barrels per day. And not only that, but OPEC had also secured the cooperation of certain non-OPEC countries, most notably Russia, in adding an additional cut of 600,000 barrels per day. And that was something that really nobody expected, so really quite a surprise for the market. And Brent went from not long before the OPEC meeting having lows around $46 per barrel, which indicated a really high degree of skepticism in the market that OPEC would be able to do anything, up to a new high of the year not long after the meeting of $55 per barrel. But there was still significant skepticism because it appeared that the agreement of OPEC members to cut was contingent upon the agreement of non-OPEC members to cut. And at that time, we hadn't seen a clear agreement from directly from those non-OPEC members that they had actually signed up to this cut at all. So we had to wait until last weekend for that to happen. And indeed, as it happens, they did, it seemed, agree to the cut of 600,000 barrels per day, with half of that cut coming from Russia. So, what does all this mean? We seem now to have a total cut of around 1.8 million barrels per day. What does this actually mean in practice? Well, the first thing to consider is what is this cut in relation to? Because we've seen that November production figures from OPEC have come in at even higher than they were in October. But October has been chosen as the baseline. The second thing is, well, what actually was October production? Because there are a range of opinions about what OPEC members actually produced. The IEA thinks it's 33.8, OPEC itself says it's 33.6, and others think it's as high as 34. Well, just for the purpose of this discussion, we're going to stick with the IEA figures so that we're consistent. So the IEA thinks 33.8 million barrels per day. If you apply OPEC's cut to that, where the agreement actually is actually a bit less than 1.2 million barrels per day, so you get to a figure of something like 32.7 million barrels per day of OPEC production in 2017, where these cuts are due to take effect. So that's actually a little bit higher than OPEC itself had implied its production would be. Nevertheless, a cut of significant magnitude. Now, the IEA published their monthly update for December just a few days ago, and in that they estimated that the call on OPEC, that is the amount that OPEC would need to produce in order to balance the market in the first half of 2017, was 33.3 million barrels per day. And that's up from its estimate in the previous month, because of course it's now factoring in non-OPEC members cutting their production. Now, if OPEC was going to produce 33.3 million barrels per day, that would balance the market. But what we're being told is that OPEC is actually going to produce something like 32.7 million barrels per day, leading to a deficit of about 600,000 barrels per day. So perhaps a little less of a deficit than we might have thought based on the headline numbers, but nevertheless a sizable deficit. Now, there are some risks to this, clearly. So the first one would be that OPEC members, or some significant OPEC members, might not quite play ball with what they've agreed to. and it could be a little bit into 2017 before we're really clear whether people are cutting or not. So we won't know the figures for January until early in February, and at that point it could still be argued that maybe because of technical reasons or whatever, that the cuts are taking a little bit of time to come through. So it mightn't be until, say, March before we're really confident about what the intentions of OPEC members really are, whether they intend to honour this bargain. The Saudis have come out very much ahead of the game, though. There's evidence that they've already been telling customers that they intend to cut production. And indeed, on top of that, they've said that they would actually go beyond the production quota that was agreed on the 30th. So they definitely mean business. But we might find that the Iranians have actually gone ahead of the latitude that they have to produce a bit more, or maybe the Iraqis have not put through their cuts. We'll have to wait and see. Similarly with the Russians have said that their production cuts will come through gradually in 2017. They have to pass these cuts down into their oil companies, because they don't have a single national oil company. So again, that's not a trivial thing to implement there. Then there's US shale. I mean, this is the thing that's constantly being brought up. Perhaps US shale will just switch on and offset the OPEC deficit. But that seems unlikely that could happen rapidly in 2017. It's probably something more towards the end of 2017 when there is likely to be additional demand anyway. So we'll have, but that needs to be watched carefully. I'd also mention Libya, as this has been in the headlines this week, that some additional Libyan fields are coming back online. But the reality is that Libya is unstable, that it has difficulty in consistently producing from these fields, so I think we should take that with a pinch of salt. Finally, there's the question of inventories. Now, OECD inventories currently stand at around 3 billion barrels, and that compares to recent historic averages of around 2.7 billion barrels. So in order for the deficit that we think we might have in the new year of 600,000 barrels to erode that excess stock, it's probably going to take over a year of that kind of deficit. And it's possible, given that the forecast for increased demand, that OPEC could, if it wanted to, and if its members cooperated with it, it could decide to roll over these cuts, which currently are due only to apply to the first 6 months of the year, at its May meeting into the rest of the year. It could actually maintain that deficit and could lead to a significant drawdown in stocks, based on the projections we're looking at the moment. So that's certainly possible, but there are definitely risks there. Anyway, moving back to how the market has reacted to this, well, we've had a new high of the year, $58 per barrel. That seems an extraordinary figure compared to the January low of around $27 per barrel. But it's worth bearing in mind that as recently as May 2015, when the oversupply in the market was about at its greatest, we actually saw Brent trading as high as just under $70 per barrel. So there certainly is plenty more upside scope. It's perhaps been a little surprising that the market has actually softened during the course of this week. But I think that may have a lot to do with those who've been long, who've taken a bet that oil would rally, have done well out of that strategy, reducing those positions. As we come into the year end, liquidity tends to reduce, and I think we're going to see people taking those positions off in the run up to that. And at the same time, those that might be tempted to increase positions are wary of doing so. So it may be until the new year that before we start to see more of a reaction to this, to what OPEC have decided. It's worth noting that in terms of discussions with consumers, that we're seeing really very little interest. That the theme is very much one of, well, we'll just wait and see. It takes a little time for this step change we've had in the market to crystallise and become accepted. But overall, I think there are definitely reasons to be cautious about the cuts that OPEC have announced, but it does seem that the Saudis in particular definitely mean business this time, and so there is definitely scope for more upside from here. We may, as we get into the new year, start to see Brent returning to the uptrend that it had from the start of this year, and that does mean that we could see oil go through $60 per barrel, maybe